The IRS has officially released the 2026 federal income tax brackets, along with new standard deductions and key updates that could affect how much of your income is taxed next year. Whether you're a salary earner, freelancer, small business owner, or retiree, these new numbers could mean the difference between keeping more of your paycheck or owing more in April. In this video, we're breaking down everything you need to know about the 2026 tax brackets, including what changed and what stayed the same. Who benefits most? Real examples showing how much you'll actually pay, and smart tips to plan ahead and save money. Stay tuned till the end for Chapter 10, where we'll show you how to protect your income and legally reduce your taxes in 2026. Why 2026 brackets matter. Tax brackets determine how much of your income is taxed at each rate. The IRS adjusts these brackets every year to keep up with inflation. These small changes can make a big impact, especially if you're close to crossing into a higher bracket. Key points: brackets prevent bracket creep, where inflation pushes you into higher taxes unfairly. Your marginal tax rate, the rate on your last dollar earned, can change even if your income doesn't skyrocket. Adjustments ensure that your cost of living increase isn't eaten up by taxes. So, while the tax rates themselves stay the same, where your income falls inside those brackets can shift dramatically. What rates stay the same? For 2026, the IRS kept the same 7 federal income tax rates: 10%, 12%, 22%, 24%, 32%, 35%, and 37%. However, the income ranges for each bracket have been adjusted upward. This means that your income has a little more room to grow before it's taxed at the next higher rate. That's good news for most taxpayers. It helps offset inflation and prevents automatic tax hikes. 2026 bracket thresholds for single and joint filers. Let's look at where each rate starts and ends under the 2026 brackets. Single filers. 10% up to $12,400. 12%, $12,401 to $50,400. 22%, $50,401 to $105,700. 24%, $105,701 to $201,775. 32%, $201,776 to $256,225. 35%, $256,226 to $640,600. 37%, over $640,600. Married filing jointly. 10%, up to $24,800. 12%, $24,801 to $100,800. 22%, $100,801 to $211,400. 24%, $211,401 to $403,550. 32%, $403,551 to $512,450. 35%, $512,451 to $768,700. 37%, over $768,700. These changes might look small, but for families near the upper limits of each bracket, it could mean hundreds, sometimes thousands, of dollars saved on your tax bill. Standard deduction updates. The standard deduction, the amount you can subtract from your income before taxes, is also increasing in 2026. Single, married filing separately, $16,100. Married filing jointly, $32,200. Head of household, $24,150. If you're age 65 or older, you'll qualify for an extra deduction of around $6,000. That means seniors can shield even more income from taxes, which helps offset inflation and rising living costs. For many taxpayers, the standard deduction increase alone could keep you in a lower effective tax range. Why you might see little or no change. Even though the brackets and deductions have moved, your tax bill might not change much. Why? Because of how the US tax system works, it's progressive. That means each portion of your income is taxed at different rates, not your entire salary. If your income rises slightly but stays within your current bracket, you may not notice a big difference. Inflation adjustments protect most middle-income Americans from paying more taxes due to simple cost of living raises. So while the headlines sound big, many workers will see their effective tax rate stay roughly the same, or even drop slightly. Who benefits the most in 2026? This year's bracket changes benefit a few key groups. Middle-class earners, bracket adjustments and higher deductions mean a lower overall tax burden. Retirees, the increased senior deduction helps offset higher Medicare and living costs. Dual-income families, the widened joint filing brackets reduce the marriage penalty. Small business owners, more room before higher rates hit means easier reinvestment in business expenses. For most taxpayers, these updates mean a little extra breathing room in their take-home pay. Who might pay more? Not everyone comes out ahead. Certain earners may see their tax bill increase despite these adjustments. You might owe more if your income jumps significantly due to raises or bonuses. You lose eligibility for certain credits or deductions. You have large investment gains taxed as ordinary income. You operate a business with changing pass-through income rules. You live in high-tax states where deductions are limited. For upper-income households, the top 37% bracket still bites hard once income crosses those thresholds. Other 2026 tax adjustments to watch. Besides the main tax brackets, the IRS updated several other key limits for 2026. Notable changes include alternative minimum tax, AMT, exemptions increasing, reducing the risk of double taxation. Estate tax exemption rising to about $15 million, protecting more inheritances from federal tax. Earned income tax credit, EITC, thresholds and phase-outs increasing for working families. For 401k contribution limits going up, letting you save more for retirement tax-free. IRA contribution adjustments aligning with inflation. These behind-the-scenes tweaks might not make headlines, but they can save you thousands if you plan properly. Real-life examples, how much you'll pay. Let's make this real. Example 1, single worker. You earn $60,000 per year. The first $12,400 is taxed at 10%. The next portion up to $50,400 at 12%. The rest at 22%. After the standard deduction, your effective tax rate comes out to roughly 12 to 14%. Example 2, married couple. Together, you earn $300,000. You pass through several brackets, 10%, 12%, 22%, 24%, 32%. After the $32,200 deduction, your effective rate is closer to 22 to 23%. Remember, your marginal rate is not your overall rate. Even if you're in a higher bracket, only the last portion of your income is taxed at that rate. Smart tax moves for 2026. Planning ahead can save you serious money. Here's what to do now. Check your current withholding. Adjust it to match the new bracket so you don't overpay. Max out your retirement contributions. This lowers your taxable income. Plan bonuses or freelance income strategically. If possible, shift payments to stay under higher thresholds. Use deductions wisely. Compare the standard deduction versus itemized to see what's better. Track your credits. Child, education, and energy credits can all reduce your tax liability. Consult a tax professional, especially if you own a business or have investment income. A little strategy now can help you keep more of what you earn when tax season hits. The 2026 IRS tax bracket changes won't overhaul the tax code, but they'll definitely reshape how much Americans pay next year. For most middle-income households, the adjustments mean modest savings and higher deductions. For top earners, it's time to double-check where your income lands and plan accordingly. Don't wait until tax season to find out what you owe. Start planning now to make these changes work for you. If you found this helpful, hit like and subscribe to American Finance Today for more updates on Social Security, tax news, and retirement planning.